Hey, what's up guys, welcome to another beginner video. It's been a while since we've done one of these and thought it was about time we did one. Just a reminder, the purpose of this series is to supplement our main videos and help the newer investors understand some of the things we talk about. So for now, let's jump right into it. PE ratio, or price to earnings ratio, is one of the most common indicators used in the stock market, which you may see around everywhere. Now, what is PE? PE is the ratio of a company's share price to the company's earnings per share. It is generally used as a quick indicator of value in companies to find out whether the company is overvalued or undervalued. The PE ratio helps investors analyze how much they should pay for a stock based on its current or future earnings. Having said this though, there's a lot more that goes into valuing a company than just relying on this ratio, but it's a good starting place. Let's take a look at an example for better understanding. Firstly, let's start off with an easy example and then we'll take a look at a real world example. Company A has a share price of $30 and an earnings per share of 50 cents. Earnings per share can be found quite easily as well, as it's a very common figure too. Now, let's do the math. $30, which is the share price, divided by 50 cents, which is the earnings per share, which gives company A a PE ratio of 60. Now let's take a look at company B, which has a share price of $2 with an earnings per share of 25 cents, which gives company B a PE ratio of 8. This means that someone is willing to pay $60 and $8 respectively for each company's earning power of $1. Now, based on this ratio, is the company undervalued or overvalued? If company A and B's earnings never change, company A's stock is overvalued, and you'll have to wait 60 years to earn the same amount you invested back, while company B is undervalued, as it would take you only 8 years to earn the same amount you invested back. However, in the real world, how much a company earns changes every year. While having a high PE ratio may suggest that a stock is overvalued, it also means investors have high expectation that the company's earnings will grow much higher in the future. Let's take a look at a real-world example where this has paid off. Xero, which is currently priced at around $95 and has a PE ratio of 4,400, which is extremely high. In fact, 5 years ago, when the share price was just $13, Xero's PE ratio was negative, meaning that the company was making a loss. Despite this, during this time, their share price had gone up 600% as they kept meeting the high growth expectations in their revenue. In contrast, Spark had a relatively lower PE ratio of around 20, and over the last 5 years, their share price has gone up 46%, plus all the dividends that the shareholder would have received, which is still much less than a 600% increase. So, if you've done your homework and found a company with a solid product that you believe will make the company much bigger, a higher PE ratio can be justified and the payout can be good. However, be warned that with high expectations comes greater disappointments if the expectations aren't met. An example of this can be the cannabis stocks in Canada and the US in 2019. During this time, many of the stocks surged in price as people had high expectations of earnings for these companies. But if we look now, the majority of them are now down over 70% from peak. So it is critical to thoroughly understand the business when investing in high expectation stocks. So PE ratio, although it's a simple equation, it is pretty helpful in making quick judgments on a particular stock, which is why it is so used widely. Another quick way to calculate the current PE ratio is by taking the market cap of the company in question and dividing it by the company's last profit number. Hope you enjoyed another beginner series video. Make sure to subscribe for more and we'll see you next time.